Hey everyone, and welcome to the last video from our discussion on financial institutions. So, we've talked a lot about financial crises and the different institutions that not only are part of them but cause them. But in this video, we're going to finish with talking about regulation not only of the financial sector but specifically of the Fed. So, we're going to talk about the Fed's roles and the evolution of the role specifically of the lender of last resort. And then we're going to take a deep dive specifically into the Dodd-Frank Act, which was passed in response to the 2007 financial crisis. So, uh, anytime there's a financial crisis, we almost always see financial regulations that spawn from it. And so that's why it's so important to discuss financial crises in the same context as financial regulation. However, the downside of this means that it gives financial institutions a substantial amount of time to evade the new regulations by evolving new trading strategies and loopholes, and it takes until the next recession that we start to see more tightening of financial regulations. So, for example, in 1970, Penn Central Railroad filed for bankruptcy and they defaulted on $200 million in commercial paper. And at that time, that was the largest default in US history. At that point, people really started to doubt the quality of commercial paper. The commercial paper market almost completely froze up, and we risked entering into a recession right then and there. However, the Fed avoided a crisis by giving commercial banks loans that allowed banks to lend to firms who were exiting the commercial paper market. And so that was really where lender of last resort was really established for the first time and is the precedent for all future lender of last resort uh, moves by the Fed. And so in 1974, Franklin National Bank started to experience a run on negotiable certificates of deposits, or CDs, that ended up actually being worth more than the federal deposit insurance limit. And so what the Fed did is they gave $1.5 billion in loans to Franklin National until it could be merged with a more solvent bank. And so what the Fed basically did here was show and demonstrate that they can facilitate economic activity until they can come up with a healthier solution to the economy. And if that sounds familiar to you, it sounds exactly like what we ended up seeing in the shadow banking industry with the takeovers of some of these failing investment banks. And so after 1974, starting in the 1980s, the Fed and FDIC started to explicitly protect banks that were deemed too big to fail. And this was formally given as a list to Congress in 1984. So, in the first time we ever really talked about this too big to fail idea, which you hear a lot about now, was in 1984. And that was when the first formal list was given of financial firms that were deemed to be a threat to the structural integrity of the financial system if they were to go bankrupt. And so, after the too big to fail policy was developed in 1991, the FDICIA Act was passed and required the FDIC to deal with failed banks at a cost which minimized taxpayer expense. And this was really the first wide scale critique of the too big to fail policy and the first response to it. And what the FDICIA Act did was require the Fed to always use the least expensive method of dealing with a failed bank in terms of taxpayer expense. And like almost all the time, that means that the Fed is required to facilitate the closing of an insolvent bank and then reimbursing insured depositors, then selling off the bank's remaining positive assets to reimburse uninsured deposits with the remaining funds. But this sounds really uh, questionable in the context of the 2007 recession. You have to be asking, how can the FDICIA exist and then the Fed do what they did in 2007? Well, the reason for that is because there is an exemption in the act which allows the Fed to avoid this act if a bank's failure could cause serious adverse effects on economic conditions or financial stability. So there are ways around the FDICIA Act, and we saw those really come to light in 2007. But in order to enact this clause, you have to have a two-thirds majority vote from the directors of the FDIC, two-thirds of the Fed's Board of Governors, and the Secretary of Treasury to all agree that it is important for the Fed to do something other than minimize taxpayer expense because of the economic conditions that failing would cause. And so this was really what we had to go through to get through all these bailouts to occur. So it wasn't just the Fed unilaterally acting. You had the FDIC on board, the Board of Governors on board, and the Treasury Department all on board in order for the Fed to do what we talked about in the last video. Now, an important note under the discussion of lender of last resort is that investment banks are not even eligible to borrow directly from the Fed, and the loans to investment banks are not FDIC insured. So that means that the discussion of investment banks and the shadow banking industry is really used to be a very gray area uh, for the Fed to regulate. And so the Fed, up to 2007, dealt with investment banks in crisis by buying commercial paper from investment banks to meet short-term credit needs. And so basically these are just short-term loans to investment banks. But they had to get bigger in 2008, especially in March when they brokered the deal to sell Bear Stearns to JP Morgan Chase. And then on top of that, they covered up to $29 billion in losses to JP Morgan Chase by buying all of Bear Stearns MBSs and providing insurance on them. So this was really an extension of what the Fed was eligible to do under their charter. And they repeated this once again with the approval of the FDIC and the Treasury Department. In fact, the only large financial institution it allowed to fail was Lehman Brothers, controversially. And so that made a lot of people return to this idea that the Fed had adopted a too big to fail policy, which was the whole problem initially. But there were also critiques on the opposite side about why the Fed didn't bail out Lehman Brothers. And Ben Bernanke is on the record of saying that it was a solvency issue, that Lehman Brothers was so insolvent that there was no way that the Fed had the ability to inject the capital necessary to that would make sure Lehman Brothers wouldn't go bankrupt anyway. And if they didn't go bankrupt anyway, that means that the Fed is just throwing money at Lehman Brothers. So there had to be this expectation that Lehman Brothers could reasonably try and repay all the money that the Fed gave them through commercial paper and otherwise. And the fact that they didn't meant that they weren't going to get a bailout from the Fed. However, Ben Bernanke's position has frequently been critiqued as a way of picking and choosing who the winners and losers were from the financial recession, about it was just Fed in action, and that it was an experiment in the Fed to see what would happen to the financial system if they let these banks go under. So really a controversial decision to let Lehman Brothers go under, especially in the context of what it did for the other large investment banks. And in all of this discussion, we got the Dodd-Frank Act. It was passed in July 2010 to increase regulation and oversight, specifically in the shadow banking industry and especially on investment banking. And the stated objective of the Dodd-Frank Act, directly from the Act, is to promote the financial stability of the United States by improving accountability and transparency in the financial system to end, quote unquote, too big to fail, and to protect the American taxpayer by ending bailouts to protect consumers from abusive financial practices and services and for other purposes. So when we look at this statement, very first paragraph from the Dodd-Frank Act, we can pick out a couple things. First, too big to fail. Again, we're just returning to what happened in the 80s and 90s with this large critique of too big to fail policy for the Fed. And this critique of the Fed propping up large, irresponsible banks, and in doing so, promoting moral hazard. And it did a couple specific things within the Dodd-Frank Act. It wasn't just talk. Uh, One of the big things that it did is it created the Financial Stability Oversight Council to identify what it called systemically important financial institutions. And if that sounds suspicious, that's because it is. A sci-fi is just another term for a financial institution that is labeled as too big to fail. And these financial institutions, they have to go through annual stress tests to see what would happen if a financial recession were able to occur or were to occur, what would happen to the institution. They also have very close supervision, and they also have to write and consistently update living wills to explain how, if they were to go through bankruptcy, they would do so without hurting the American taxpayers. So there is a specific demographic of financial institutions that got a lot of additional oversight. But again, these are just a different dressing on the idea of too big to fail broadly, but they did add more oversight to them. Additionally, the Dodd-Frank Act gave orderly liquidation authority where the Secretary of the Treasury could order a failing financial firm to be taken over by the FDIC. So, what this clause does is really take away unilateral authority from the Fed and disperse it to the Treasury and then the FDIC so that there is a little bit more disbursement of power in the times of crisis. Now, it does have other secondary provisions that are still quite important. One that we've referenced a few times indirectly is it increased depositor insurance in commercial banks from $100,000 to $250,000. And what's really interesting about this provision is that it was framed in the context of protecting depositors, whereas if you remember, deposit insurance was actually introduced to protect the financial system. Additionally, there are increased reporting requirements for hedge funds, but as I mentioned, still not significant. We still don't know a lot about their operations. There is also increased oversight and regulation in the insurance industry, and that stems from the potential failure of AIG, which we talked about a couple chapters ago. They also created the Consumer Financial Protection Bureau. They increased congressional awareness of Fed actions. They limited further Fed actions, and they increased access to financial institutions for low and middle income Americans. However, the Dodd-Frank Act has been reduced in size since. It's specifically in 2017 and 18. In 2017, Congress passed the Financial Choice Act that had a few provisions. First, it gave Congress additional oversight over the Consumer Financial Protection Bureau. It repealed orderly liquidation authority, giving that power back to the Fed. They also tried but failed to impose rules on how the Fed can impose interest rate changes. And they wanted these rules to be based on what we call Taylor's rule that we're going to talk about in chapter 15. And then they also passed in 2018 the Economic Growth, Regulatory Relief, and Consumer Protection Act, and that really limited Dodd-Frank's scope. So one thing that it did is increased the sci-fi requirement to $250 billion. So any bank with a market cap less than $250 billion was exempt from these additional regulations. Additionally, they eliminated speculative investment provisions in what was called the Volcker rule in the original Dodd-Frank Act for banks smaller than $10 billion. So the Volcker rule limited what banks can invest in, and they removed that cap in order to try and make smaller banks more competitive in financial markets. And with that, if you have any questions about financial regulation or the Dodd-Frank Act, I encourage you to email me, but otherwise, you are now ready to take your Chapter 12 quiz.